The United States economy is operating at peak capacity. Corporate profits are surging by 7% year over year, and unemployment across the OECD has dropped to a record low of 5%. Yet underneath this high-velocity growth, the federal government is running a structural budget deficit that exceeds 6% of gross domestic product. This combination contradicts standard economic models. Deficits of this magnitude are historically deployed as emergency measures, tools to pull an economy out of a deep recession or to fund a major war. We are witnessing a pro-cyclical fiscal expansion. The government is heavily stimulating an economy that is already at full employment. Maintaining emergency-level borrowing during an economic boom removes any shock absorbers. It signals an underlying systemic fragility that leaves the broader financial system highly exposed. The United States benefits from the dollar's status as the world's primary reserve currency, that economic advantage often called its exorbitant privilege. This privilege leads to a common analytical error, the assumption that a massive debt load mathematically guarantees a national bankruptcy. Because the U.S. issues debt in its own fiat currency, it can always create the liquidity needed to pay its creditors. A traditional sovereign default is virtually impossible. Instead, the pressure of unchecked borrowing mutates, transferring the strain into other, less visible market mechanisms. The future of this fiscal trajectory will be dictated by three specific variables: rising term premiums on bonds, the strict limits of tariff revenue, and the central bank's political independence. The hazard of a 6% deficit is not a sudden, dramatic national default. It is the invisible, mathematical constraints of this borrowing trajectory that will inevitably squeeze the global economy. This chart breaks down the 6% deficit into three compounding structural pressures. First is the primary deficit, the base shortfall between government spending and revenue, around 3% of GDP. Second, entitlement obligations expanding with aging populations. Third, higher interest rates drastically increasing the cost to service existing debt. We see the U.S. 10-year Treasury yield, currently around 4.4%, trending dangerously close to the projected line for nominal GDP growth. This convergence is a critical threshold. When the interest rate matches or exceeds economic growth, the debt burden compounds autonomously, regardless of tax policy. To finance this compounding debt, the government must issue a massive volume of new treasuries. Investors absorb this supply, but they demand a higher term premium, extra compensation for holding long-term debt, which drives borrowing costs up further and deepens the original deficit. The proposed political solution to this fiscal strain centers on the One Big Beautiful Bill Act, a legislative strategy designed to use aggressive international tariffs to offset domestic deficit spending. As a targeted, localized policy, it is generating capital. Federal customs revenues have increased geometrically as higher tariffs are applied to global imports. This chart from the St. Louis Fed tracks federal customs duties. We can observe an exponential vertical spike in government receipts leading into 2025. The mechanics driving this revenue involve cost absorption. Regional Fed surveys estimate a 50% pass-through rate, meaning half the cost is paid directly by American consumers through higher prices, while the remainder eats into corporate margins. Scaling to the macroeconomic level, can this spike close a 6% budget gap? This pie chart represents total U.S. government revenue. Even with a 5x multiplier, customs duties remain a marginal fraction. It is structurally impossible to substitute the massive revenue from domestic income and corporate taxes with border taxes. Furthermore, when these tariff increases are paired with corresponding cuts to domestic corporate taxes, the strategy fails to generate net new revenue. The primary deficit remains entirely untouched. These border policies also create a secondary drag. Tariffs act as an additional tax on global exporters, stripping capital from international supply chains without repairing the American balance sheet. Tariffs serve as a potent geopolitical tool to reshape trade networks, but mathematically, relying on them to fund a 6% structural deficit is an illusion. If the deficit cannot be closed by taxes or trade policy, the pressure transfers to the monetary system. We must examine how a mathematically unclosable deficit survives institutional stress. There is escalating political pressure on the Federal Reserve to artificially lower interest rates. Doing so would immediately ease the government's borrowing costs. This tension has introduced a gray swan event into bond markets, an improbable but highly impactful risk, the potential targeted dismissal of the Federal Reserve Chair. This chart tracks the market estimates of this severe institutional breach. Decentralized prediction markets are actively pricing in a nearly 1 in 5, or 19% probability, of the Fed chair being ousted by the end of 2025. Compromising the central bank's independence carries distinct consequences for a heavily indebted sovereign nation. Central bank independence is the primary mechanism that anchors long-term inflation expectations. It signals to markets that policy will prioritize price stability over political convenience. If bond markets determine that a newly appointed, politically compliant Federal Reserve will cut rates simply to monetize the government's 6% deficit, then long-term inflation expectations become instantly unanchored. Investors anticipating higher inflation require greater returns to protect their purchasing power. They demand higher yields, which paradoxically pushes long-term nominal borrowing costs up. This triggers a violent feedback loop. Higher long-term yields immediately inflate the term premium, making the structural deficit even more expensive for the government to carry. Attempting to politically dictate lower short-term interest rates backfires. It triggers a surge in long-term borrowing costs that actively accelerates the fiscal spiral. We are left with a strict set of parameters. The deficit cannot be simply outgrown, it cannot be closed by international tariffs, and borrowing costs cannot be legislated away by compromising the Federal Reserve. Yet a sovereign government issuing debt in its own fiat currency will not suffer a sudden, explosive bankruptcy. This decision tree illustrates the actual mechanisms available to policymakers facing an inescapable debt trap. A traditional liquidity crisis, or hard default, can be strictly eliminated from the equation. That leaves two realistic pathways. The first is central bank intervention to tolerate or actively stoke sustained inflation. By allowing inflation to run consistently hot, the government slowly devalues the underlying currency. Over decades, this effectively inflates away the real burden of the debt. The second pathway is financial repression. Financial repression relies on implementing strict regulations that suppress private investment and consumption. This forces domestic capital, such as pension funds and banks, to absorb massive quantities of government debt at below-market rates. Both of these outcomes stand in stark contrast to the frictionless, high-velocity economic momentum we observed at the beginning. The ultimate risk of running a 6% budget deficit at full employment is not an overnight collapse. It is a slow structural squeeze that gradually suffocates the private sector dynamism that built American prosperity.